This episode, Max, he's awesome. One of my first friends growing up. You'll hear about it in the show. Okay, so Max is an incredible story because he started off as a mortgage loan officer and he was able to scale his business over time. He's really the epitome of how to build a great business in real estate. Take a look for yourself. All right, here we go. Max, what's up, man?
How's it going, bro?
It's good. It's good. It's good to see you.
Yeah, you
I
too.
love that we're doing this.
I can't believe it.
So I kind of have to share that Max was my first friend when I moved to America as 2 or 3 years old. I didn't speak any English. He didn't speak any Spanish.
I still don't.
And really? I've heard you speak Spanish.
A couple
sometimes.
words here and there.
That's good enough. I mean, that's like me. I kind of
right.
forgot a lot of my Spanish, unfortunately. People speak English back to me when I speak in Spanish. I'm like, it's that bad? Really? That sucks. I love it, man. I love what you've built. It's an honor to be here. I'm so happy that you're letting me do this. And, you know, you've told me a little bit about your story in the past. And it's really a crazy success story. And I don't know, do you want to sort of talk about your company, what you've done, how you got here?
Yeah. So Loan People is my company. We opened our doors January 2020.
Wow.
I started as a loan officer in 2001.
Wow.
And
Okay.
through the years, just kind of built up the team. And my girlfriend at the time, now wife, Dana, she joined in 2009
Okay.
and really started doing a lot of marketing for us. And I was always a really good technician, and she's an amazing marketing person. And when we put those together, this thing just kind of exploded. Fast forward, LEAMAN team had become, number one in Texas and top 10 in the nation for around 10 years in a row. And we decided that, eventually it was just like, look, let's just do this on our own and let's build a platform.
Mm-hmm.
We call it FlowBlow, for
Yeah.
loan officers, by loan officers.
Yeah.
And have a platform where loan officers can come. It's extremely transparent. You can see everything. There's not a lot of layers of management, so it allows our pricing to be super aggressive. And then give the loan officers that join us the same marketing machine and materials that allowed LEAMAN team to get to 300, 500, and then in 2021, 700 million
Wow.
in production. So that's what we did. We started it and opened the doors January 2020 and didn't know what was going to happen. Pandemic hit. That was pretty scary.
Yeah.
And then things exploded.
Yeah.
We were fortunate enough to grow, and we've started adding branches in 2021 and 2022 and 2023. And so, we're growing from here.
I think what's kind of inspiring to me about that, and I think sometimes people have these big dreams to be maybe where you're at and where a lot of people have arrived at. The thing
Yeah.
is that it's hard to get there in terms of you started with a mortgage company, you built your team, you built your business, and circumstances just led you to where you are here. Coming straight here would have been very difficult. And seeing the choices you made, the risks you took throughout that time,
Yeah.
I mean, that's the way to do it. You shouldn't, I think, overextend yourself if you're not ready to go there. And people want to go there, and I get it. But I mean, when you started Loan People, you had a client base,
Yeah.
and people come to you because it's you
Right.
and how you treat them.
Yeah.
And even your employees. I mean, the for loan officers, by loan officers, I think the culture you've cultivated and that you try to cultivate, it transcends to your clients.
Yeah.
So I think that's really special. And you keep your clients happy that way, and you work hard for them. So
Yeah,
it's
no,
cool.
and that's kind of the thing, right? It's always we, not me. This is everything's about the team. Whether it's loan officers, processors, underwriters. At the end of the day, closer, secondary, we're all working together for the same goal,
Right.
And we're all one team, and everybody really needs to be bought into that for it to work. And along those lines, we've kind of decided, Loan People is not a company for everybody. You may be the highest producer in the world, or you may be the best underwriter in the world, or the fastest closer in the world. But if you can't be nice and respectful, then you just can't work here. And,
Right.
and for us, it's all about the team environment and working together and getting along, being respectful, everybody really vying for that same goal. So that's what we're building.
Right. Yeah, that makes total sense. I love how you talk about your wife, that she was the marketing expert. And I was going to ask you this question because to build a business and to be a loan officer, you have to be organized and very structurally. You have to be able to think very structurally. That's the opposite of creativity.
Mm-hmm.
I was wondering how you balance those two and when you pick like which brain to use.
You know, it's interesting. So obviously I've had a lot of help. A lot of people along the way have helped us build this company, director of operations, COO. It definitely wasn't just me.
Right.
What I find that I'm really good at is finding good, smart people to help in things that I don't know how to do or that I'm not good at doing.
Right.
You know, as a loan officer, when we first started the company, I was number one in sales, and kind of balancing the role of even I want to get this loan done. Do I have a sellable loan? Was a very interesting dynamic for me to start to deal with because as a loan officer, every deal works. You want every deal to close.
Right. Right.
But as an underwriter, the underwriter's job is to protect the company and make sure that you're not originating a loan that won't sell.
Right.
And then as the owner of the company, I don't want to get stuck with a loan that I can't sell because now I've got that loan on my books and I'm out that cash and I've got to figure things out. So I've really learned along the way by listening to everybody around me and taking advice from people around me when I need to kind of put that hat on or when I take that hat off and put the creative hat on. And you just kind of trial by fire.
Right. Okay. That makes total sense.
But it's really, I mean, at the end of the day, I mean, it's really about more than anything, having the right people around you to help you make all the right decisions.
I think, you know, it's funny. I talk to some business people. I'm just curious about business sometimes. And I ask a lot of, some people really assign the value of their business to the team that they put together.
Yeah.
And they take pride in their team and, you know, doing that. So I think that's great. So what were your goals as a young man? Like, how did you see yourself in the future? Because I know you've had a lot of life experiences.
You know, I never really knew. I knew through high school, I was always a worker. You know, school wasn't really my thing. I wanted to work. I wanted to make money. I wanted to lead. You know, I was a manager of 5 bagel stores in high school. So I'd leave school and go manage these 5 or 6 different stores over DFW. And I'd have employees that were 50 and 60, and I'd have to tell them, you know, you're overstocking here, you're overstaffing here, you're under this and under that. And, you know, that was definitely interesting as a 17-year-old, 16-year-old telling these 50 and 60-year-olds why they're doing things wrong. And by the way, I've got a math test that I got to take tomorrow.
Right.
That was just always kind of in my nature. I always wanted to lead. I just kind of had a knack for it. I didn't know what I wanted to be.
Right.
I just knew that I wanted to ultimately be self-employed.
Okay.
I wanted to have a business.
Yeah.
I didn't know what that was. And for a long time, I really thought as a loan officer, I was self-employed. Even though I was working for other companies, which to a certain degree was true because it's my book of business. Yeah. You know, we're generating all those leads. I'm controlling a lot of things. But through certain circumstances, it was made very clear to me I was not self-employed.
Right.
Things were going to be the way those companies wanted them to be, and rightfully so. They were their companies. Yeah. You know, so for me, it just came down to, okay, then I want to do this the way I want to do this. And I kind of said, if this was my company, I would do it this way one too many times, and decided to put my money where my mouth is.
That's the question. I was listening to another podcast you did, and you were talking about how you started Loan People in a way because you wanted to decide if somebody would get a loan. Still doing, you know, conforming to FHA or whatever aggregators that you need to conform to. But what are those things that you do differently or that you would maybe allow or that you're more flexible with?
So the biggest key for me is transparency.
Okay.
And I've worked for some great companies in the past, and I have a lot of respect for those companies. They helped me get to where I was.
Yeah.
But as I've My suspicions as a loan officer working for a company were that they were not being fully transparent. There was always something being held back.
Right.
What we've built here is 100% transparent. I will show people actual pricing that I get directly from the aggregators. I will show them direct price from Fannie. Right. I will show them purchase advices so they can see what we made on a sale. You know, for the branches, we're on what's called well, back in the day we called it a net branch model. But I'll show a branch exactly what corporate's making and exactly what we're taking from them, and we have different mechanisms both to keep me honest and for them to know that we're being transparent.
Right.
I didn't want a lot of layers of management. You know, I found that having a lot of layers of management, A, didn't do a whole lot for me as a producer, and B, made my rates worse because you've got to pay for all those people.
Right.
So that was really kind of the crux of, I'm going to just do it this way. And then everybody's got a different level of risk tolerance.
Right.
You know, my risk tolerance is pretty high. You know, I'll push the envelope pretty far. Other companies
in terms of what you could sell, or in terms of,
well, in terms of what I think I'll be able to sell.
Right, right.
You know?
Interesting.
So, you know, if we approve a loan, we close a loan, now I've got to go sell that loan after the fact. So are we making decisions that are going to allow us to get a loan sold or not?
Okay.
Fortunately, we've been very lucky, and we really haven't had but a handful of loans that had some issue at the end that we had to deal with. But the idea is to close as many loans as possible.
Right.
And different companies, like I said, have a different risk appetite. So maybe they'll want certain documentation for a loan that we might not feel is necessary. Or, you know, maybe they don't want to do a loan because they feel that there's certain risks of it that we might feel are not necessarily valid.
That's interesting, because that is a unique value proposition. In a way, if somebody wants to get a loan, you know, you're willing to maybe not be able to sell it, or, you know, willing to take the risk of it being a harder sell, or maybe you have to offer it at a bigger discount. The reason I'm saying this is because some people might not understand that when you make a loan, you go to sell it, and that's kind of how mortgage banks work.
Yeah, I mean, at the end of the day, no matter really the size of the company, that loan is getting sold.
Right.
Some companies service, some don't. We're working on getting our servicing, but even then, you're still selling the loan. Whether you're selling it to Fannie Mae or Freddie Mac, or you're selling it to a bank or an aggregator, at the end of the day, someone's buying that paper.
Right.
Are you originating a loan, putting a loan together that this other institution will be willing to purchase? And sometimes what happens is the loan gets purchased and it gets audited down the road, and a year later, Fannie or Freddie come knocking and saying, "Hey, you have to buy this back. Why did you do this?
Wow.
You've got to justify what you did."
Right.
You know, a year ago or a year and a half ago.
Right.
You know, so it's managing that risk to whatever your risk appetite is.
So here's a question I was curious about. I saw it on your website. What kind of loans do you offer? I mean, it's more than just residential mortgage. I saw you have a discounted cash flow, or the DCSR.
Yeah. So what that is? So obviously we're all residential, 1 to 4 units.
Okay.
We've got some kind of in our back pocket, some commercial stuff, but our primary focus is 1 to 4 unit properties. Conventional, FHA, VA, USDA, jumbo, all the normal stuff. But then a lot of what's called non-QM. So DSCR, which is debt service coverage ratio, which is you can buy a rental property and not qualify with any income. If the property cash flows a certain percentage at or above the monthly payment, you qualify there. And obviously there's some other stipulations that go with that.
Right.
But again, the borrower's income doesn't even come into play.
So that's like an asset-based lending where it's based on the actual
property. So we also have those too.
Oh, that's not these...
No, that's not. So that's DSCR, debt service coverage ratio, is basically qualifying. You know, if your payment's $2,000 a month, what is the potential rent of that property?
Right. Okay.
Is it $2,000? Is it $2,500? You know, there's formulas there that we look at.
Okay.
But there's also asset depletion, where we can turn your assets into income. We have bank statement programs as well, where, you know, self-employed. You know, we all know people that are self-employed write off everything they can, and the tax returns don't necessarily look like is not a fair representation of what their actual income is. So we have programs for that. You know, we've got some options as well to even be able to close residential loans under an LLC, which a lot of people can't do. Generally, you think really? LLC, you have to go get a commercial loan. And commercial loans are higher rates, shorter terms, that kind of thing. We've got an option for that. We can go up to 20 finance properties versus the Fannie Freddie regulation of 10. And then even a lot of jumbo lenders are limited to 4 finance properties. So
what's that? What do you mean by that?
So a lot of lenders have a cap on how many financed properties you can have when you come to get a loan.
I see.
So Fannie
for the
and Freddie,
individual,
yeah. So if you're an investor and you're buying an investment property that's a conforming loan and it'll be your 11th financed property, you don't qualify for a Fannie Freddie. Right. So you've got to go some other route.
Right.
So we've got a lot of different programs for people to qualify outside the normal. Just here's your bank statements, here's your pay stubs, here's your tax returns and W-2s, and go.
Okay. Well, here's a current event question. And I don't know if it's an easy question to answer, but this whole like bank panic that they're having with Silicon Valley Bank and First Republic Bank.
And Signature.
Signature Bank. I mean, I've heard of different opinions. What do you think of that, and how do you think that would affect, the overall market?
Well, I think it could have been really bad. I think that they stepped in. The biggest concern was runs on banks. Yeah. Right. The government did what they had to do and step in and backstopped and basically insured 100% of all depositors' deposits. And it's funny too. I was talking to a buddy a couple days ago, and he said, "Did you even know that it's only insured up to $250? I just always thought my money was safe." And I was like, "Well, yeah, I did." But I guess a lot of people didn't realize that. Right. And when you have these companies, businesses that have millions, tens, hundreds of millions of dollars, and all they're going to get is 250,000, that's going to break the economy. And if businesses and consumers don't know that their money's safe, they're going to make a run on the bank. Had that happened, if they didn't step in and do what they did as quickly as they did, it would have been really, really bad. Yeah. Fortunately, they did. So it's yesterday was kind of crazy. This weekend was kind of crazy, but today it's kind of back to normal to a certain degree. Now the Fed has a decision they have to make. Raising the discount, raising the rates as the Fed's been doing so quickly is what caused a lot of these problems. Now you could also argue that there was investment management issues, and maybe they shouldn't have taken so much in long-term bonds at such low rates. But the bigger problem is also how fast the Fed has raised the rate. It's kind of unprecedented what they've been doing. They've been doing it to curb inflation. But now we're at a situation where today the inflation numbers came out, and core CPI was hotter than expected. So inflation's not cooling the way that the Fed wants, or really that even consumers want. Yeah. So they want to continue raising the rate, but now how are they going to do that and also keep financial stability in the financial markets? Because you have a lot of these banks that have long-term bond loans at lower rates. So the higher the Fed raises the rate, the lower the value of that asset is, and that's ultimately what happened with SVB and the other banks. Right. These banks aren't required to put their mark-to-market value of that asset on their balance sheet. What
do you mean by mark-to-market?
Well, so I bought, let's say this bank had, $2 billion that they bought, and I'm just making up numbers here, so don't take that for anything other than, but you buy $2 billion worth of bonds at 2%, and today bonds are selling for 6%. Right. Well, why would anybody buy a bond from me at 2% when they can go buy it for 6%? So now my 2% bonds are worth less than the $2 billion I paid for them. You have to do the math and figure out what are they worth if those bonds are at 6%.
So mark to mark is when you.
So the mark to market is the value of
it today.
Yeah.
Oh, right. Okay, that makes sense.
And they don't have to put those. They don't have to put that loss on their balance sheet. So their balance sheet still reflected the $2 billion, again made up number, that was on. Right. That they had invested in those bonds. Yeah. People got wind of it. It was interesting, actually. I heard somebody's theory is Kramer came out on February 8th and said SVB is a great buy and all this stuff. And a lot of people have been talking about that. But one person said, that actually drove people to figure out what was going on because a lot of people started looking in and thinking,
Yeah.
maybe I'll buy this. I don't know how true this is. I thought it was an
Yeah,
interesting
yeah.
theory. And then, you've got guys like Peter Thiel who are
Yeah,
very
yeah,
influential
yeah.
and started telling people on Wednesday, Thursday last week, hey, this doesn't look right. You need to start pulling your money. And that's essentially what caused the run.
Right.
People started pulling out their deposits very quickly.
Right.
The bank then had to go sell these bonds that aren't worth what they paid for them because rates have come up so
Right,
quickly
right.
to cover their capital reserve
Yeah,
requirements. And the whole thing cascaded. So that's where we are.
So going back to something, because you sort of talked about it right now, and I don't know this, it's just interesting to me.
Yeah.
People think that things kind of stay the same when there's a recession, and I don't know if there is a trend of thing or pattern that banks follow when times are a little bit rougher. I don't know if it's still called the matrix, but banks or lenders have certain requirements during a downturn.
Yeah.
What's the nature of the beast? Like, what indicators or do the reserve requirements change? Interest rates change.
Well, interest rates change, yeah. But I mean, the first thing that starts happening is, right, everything starts tightening. So there's less liquidity, less capital. So banks aren't as apt to make loans. So guidelines tighten up. It's
what
not
guidelines, though? Is it like
lending
credit?
guidelines? Yeah. Well, I mean, the bank's appetite. What's the bank trying to do? I mean, a lot of these banks, can make up their own rules. They put it in their portfolio. It's their money. But when liquidity dries up, they can't make as many loans. So they have to be tighter on what they'll allow for loans. See, the whole thing is with the banking institution, deposits are a liability for a bank. As a consumer, you go and put your money in the bank then has to go do something with that money to earn money. So they lend it out. They make loans. They invest in T-bills and different things. Well, as there's less money flowing into the bank, there's less that they can do. SVB's problem was they took on too many deposits too quickly and had to do something with them. So in a recession, when there's less money in the bank and people don't have as much money saved, the banks are not as able to lend out as much money to as many people, so they tighten up their guidelines.
Yeah.
What will also start happening in a recession, though, you'll start to see it, and you can see it over the history of time. During a recession, mortgage rates they fall, they come down.
Right.
So for my business, you don't want to wish for a recession, and there's a lot of difficult things going on right now, and we'd give up 20 and 21 for 5 2018s.
Right.
But there's also light at the end of the tunnel, because when we are in a recession, and maybe we're there now, rates will come down. Happens every time.
Right. Oh, really? Okay. Yeah, that's what's interesting, and that's what when you said you started in 2001, your mortgage. So you've been through cycles. I mean, there's a certain, I think, sophistication or at least education you get when you've actually lived through them, being invested or in the real estate world, because you see the devastation, but you also see topics that you might not see in like a hot, we've had a decade and a half primarily of like things just going up and up and up. And so a lot of people don't talk. I mean, I was talking to a friend about inflation in Volcker 1979 and and he was like, oh, it's never going to happen again. Why do you always talk about anomalies? 2 months later, I mean, it was silly not to talk about it. They were printing so much money.
Of course.
It was like, I was talking to my dad earlier and I was saying, we're talking about the rates and maybe they're going to go down or go up. You don't know, because they might want to make the bonds a little bit more valuable to stop potential other banks from failing. And so, they might cut rates. I mean, we don't know what's going to happen.
We don't. Mortgage rates follow inflation. Fact. You can look at any chart with inflation and you can follow mortgage rate trends. And they follow it, except for during quantitative easing. So if you go look at a chart between January 2000 and January 2022, the Fed was buying up trillions of dollars of mortgage-backed securities and treasuries, which was keeping mortgage rates artificially low.
Right.
So when you go look at those charts that show you inflation coming up but mortgage rates staying down, once the Fed stopped buying mortgage-backed securities in 2022, rates started to catch up. Rates started coming up pretty quickly. Then inflation started getting real hot, real fast, and rates came up higher than they've been, in 15 years. When I got in the business, if I could get you 7%, you were amazed. And this was in 2001. And then I'd have to go back and look, but I feel like, it was probably around 2004, 2005. We started really seeing rates get into the fives.
Yeah.
And then the fours, and then the threes, and then the fours again. And there was 2 days in 2018 where rates broke 5%, and everyone, that was it. The world was over. And then they came back down, and 2019 was pretty good. And then, 2020 was what it was.
Right.
But, the Fed pumping all that money into the system was definitely the problem. So as the Fed is raising rates, they're trying to remove money supply.
Okay.
From the economy.
Right.
That's the whole situation.
That makes sense.
That's it. There's too much money out there chasing too few goods, so they got to get money out of the equation.
I'm curious, and not to predict anything, but we've been, in my opinion, in a seller's market for so long.
Yeah.
Like, we don't even know that's so normal that nobody talks about a seller's market or a buyer's market.
Yeah.
I have some stories that I've heard where you try to buy something and there's not enough, real estate, or you go to auctions during a recession.
Yeah.
And you can't sell anything because people don't have the money.
Right.
So the price just spirals downward. Cash is king sometimes, but back to what we were talking about with inflation, because I did want to make a point. You were talking about inflation. That's why real estate is so great.
Yeah.
I mean, inflation is hedged a lot by real estate investments.
That's right.
Unless you have like a Walgreens with 50 years left that are fixed or whatever. And even if it is at the end of 50 years, it's fine. But that's like having a bond. But if you have most real estate, especially residential, adjust if it's Airbnb, it adjusts every time you rent it out. Hotels every day, rent apartment buildings every year usually, because it's 1-year leases, and commercial it's like 5 to 15-year leases. So
yeah. So you said something earlier that I wanted to go back on. We've seen these cycles before, and the one thing that I learned from the last cycle, when everything started 2008, 2009, that lasted about 1.5 years. You could argue we're really close to being a year into this new cycle now.
Yeah.
Maybe even a little bit more. What I learned through that, and what I've seen through the years, is it always comes back. So even if real estate dips some, even for people that bought in April and May of 2022, whose homes are not worth today what they were worth when they bought them a year ago, you fast forward 2 or 3 or 4 years from now, they're going to be just fine. Things come back. The stock market, people's portfolios. I remember talking to a lot of people who are really upset. My 401k is a 201k now, or a 101k. And, I've lost hundreds of thousands of dollars, if not millions of dollars of value in my stock portfolio. It always comes back.
Right.
If you, as an individual, as a family, as a business, can retain enough capital to get yourself through however long those periods are, 1 year, 2 years, whatever it is, everything will come back.
I mean, having reserves or having cash in the bank to keep you afloat during times like that. I mean, I also talk a little bit about low leverage. Yeah. But the thing with low leverage, and it's great, I think having lower leverage tends to be a little bit safer, is that not everybody could just, pay off 50% of their loan or whatever. So having that nest egg to keep you afloat during those times is when you don't want to get caught in the storm.
No, and you also want to, they talk about dry powder a lot, right? Like, if you're a real estate investor, the best time to buy is in a recession. Buy low.
Yeah.
You know what I mean? So, like, being prepared for those times, and not getting caught in the FOMO when everything is going bananas, and having to buy right then and doing all of that, being methodical, being prepared. That's how you get through the bad times. That's how you create longevity. For my company, we practiced that. Yeah. 20 and 21 were the greatest years in the history of the mortgage industry. They'll never be repeated. Well, maybe you shouldn't ever say ever, but
really,
because
the rates are low.
Rates were 2.5%. I mean, it was the it was the greatest time ever.
Yeah.
And there was a lot of people out there that spent all of that money thinking that it was never going to end. We kept a lot of money in the company. As a loan officer, actually those first 2 years, I brought home less money than I'd brought home in 10 or 12 years.
Wow. Yeah.
Because I kept it all in the company.
Yeah. Yeah.
And now we're going through a rough time,
Mm.
but we're going to weather through it. We've got enough capital to get us through.
Mm.
You know, and just like everybody else, we've had to make tough decisions, and there's
Right.
certain things that we've had to do, but our doors are still open, and there's mortgage companies closing every single day.
Yeah.
You know, and we're in a position that we could look to acquire those companies, or if they completely fall out and loan officers need to come over,
Right.
we're in a position to be able to bring people on for that. So,
Right. Okay. Interesting. That's great. Do you have a favorite loan that you funded? Or are they all similar? Because you got to be creative.
There's some that stick out. Definitely through the years, customer names stick out. I don't have one specific favorite loan, but as a loan officer, the loans that you save, that someone's in a bad spot, they're closing in a week or two.
Yeah.
Current lender can't do it for whatever reason. You got to step in and save the day. That's, to me, that's a high like no other.
Yeah.
You know, that is
Yeah.
that's the adrenaline rush. Working with celebrities, and I've worked with a lot, actors, directors, coaches. Working with high profile people is always a lot of fun. Getting to know them. Some are awesome, and really cool. And I've always liked getting to know high profile people and high net worth people. How are they doing things?
Yeah,
What are they looking
yeah.
at? How do they manage their money?
How are they structured?
Yeah, you know, and a
legally?
lot of, it's funny. I mean, you see a lot of these people, and they're kind of like the rest of us. You know, they don't know what they're doing, and they don't have it all figured out.
Right.
And then there's others that have amazing teams of people that keep them protected and keep them structured. I couldn't say that there's just one favorite loan.
Right.
There's favorite clients.
Yeah. Well, that makes sense. And
Yeah.
you're getting to know people. I think that's part of the, I don't know, something, because since I'm not in the business, it's not all check marks, you know?
There's so much gray. And like we were talking about earlier, you can have one company that'll do a loan that 2 or 3 other companies won't.
Right.
You have guidelines, right? But it's not just check the box. It is how do you interpret the guideline, and are you meeting the guideline?
Okay.
And that's, you know, we always say the mortgage industry is not black and white. And if you can't live in the gray, you shouldn't be in the mortgage business.
Right. Yeah.
You know, it's really how do you interpret things, and can you sell what you're interpreting to a third party?
Yeah. Okay. Interesting. So it takes creativity and intuition.
Yeah.
That was another question I wanted to know, because I use intuition, or brokers, or, investors, you sometimes have to have a feel of the market, of how much you could push it, what rents will be when you're done with the construction project. I didn't know how intuition plays in being a loan.
Oh yeah, certainly. Like if you're looking at this weird deal or this tough deal, you're definitely asking the question, do I think this guy's or this lady's going to pay this mortgage? Right? Like if I get stuck holding this loan, are they going to make the payments on it?
Right. Okay.
And that definitely plays into it, and that'll definitely kind of sway where in the gray you are and how you're interpreting a guideline.
Right. So I'm going to ask, just because I feel like it's relevant, what states do you lend in? And because I don't know what the difference is. I don't know how you pick states to expand in. I know you can loan in 48 states. I think, right?
No, no. So we're licensed obviously in Texas,
Okay.
New Mexico, Colorado, Oklahoma, Arkansas, Tennessee, Florida, Alabama, and currently working on Washington State and California.
But do you loan in all those states, or are you starting up in those?
Yeah, well, we don't loan in Washington and California yet
Right.
because we're not licensed there, but we do lend in all the other states that I mentioned.
How do you pick which state to go to?
Some is by necessity from what the loan officers want. Some is by just like I just want to be in Colorado. Right. So that was the first state outside of Texas that we got licensed in. So it's you kind of weigh like, who do you want to attract? What do the people that you currently have here, what do they need? What places are business friendly?
Right.
There's some states out there that we probably won't ever get licensed in.
Okay.
Some of those in the Northeast that make things
Oh,
kind of
really?
difficult. Yeah.
Okay.
You know, so you kind of have to balance all that. Plus, every state that you're licensed in, you have to follow their rules. So
Right.
you've got to take another test. You've got to provide certain documentation. You know, once we're licensed in Washington State, we're going to have to file quarterly taxes in the state of Washington.
Wow. Okay.
You know, so there's a lot of stuff. California's got a ton of regulations. So a lot of people don't want to be licensed in California
Right.
because it's not worth the time or the headache.
Okay.
You know, so it's kind of a balance of all of those things.
Okay. Interesting. What advice would you give to someone who wanted to invest in real estate?
Don't wait. Don't wait. Everybody's worried about interest rates. And that's always the thing. I'm going to wait till rates come down.
Yeah.
Or I'm going to wait till prices come down. The fact is, they work against each other. As rates go down, prices go up because demand goes up.
Right.
Don't wait. Don't try to time the market. I heard a really good saying, and I'm stealing it from somebody, and I don't remember where I saw it or who said it. But it's not timing the market. It's time in the market. Right?
Wow. Yeah.
You buy something today, 10 years from now, you're going to be great. You buy something 2 years from now, you're going to say, I wish I would have bought 2 years ago. Everybody that didn't buy in 2018 and 2019 and bought in 20 and 21 and even the beginning of 22 wish they would have bought earlier.
Yeah.
Right? You'll never time the market. Don't worry about rates. You can always refinance. Rates will come down. Will they be 2.5% again? No.
Right.
You know, are they going to get into the 4s again? Sure. Could they get into the 3s again? I think so.
Yeah.
You know, so it's don't wait.
Yeah. I love watching your social media because you do have, you have thoughts on inflation or you're watching everything. You have like some interesting insights.
Yeah.
So
Thank you.
I mean, it'd just be Max Leaman, LEAMAN, for people that want to check you out.
Yeah.
But it's fun. It's nice to watch, and you're
Yeah,
so
thank you.
personable that like it's fun to watch you. Maybe because I've known you for too long.
You know, it's funny. It's super uncomfortable just sitting there talking to a camera in my B-roll. I finally
It's
figured
weird,
out I
yeah.
don't have to start and stop it. I could just go and then cut it
Oh
down.
yeah, I got some videos to show you about that.
It's funny. You know,
my
there's
God,
a lot of throwing things and cursing when I mess up, and then.
Oh really?
Yeah.
I have some B-roll to show you.
It's pretty funny, but you know, people have said they want to hear from me. You know, I guess I have things to say, and you know, I'm fortunate enough that have enough people that care about what I have to say. So I try to put out things that are useful for real estate agents, for loan officers, for buyers. You know, so I've started doing that, and I need to get better at it.
Your insights are very interesting, and you're usually pretty accurate with your predictions. I think
most
at least
times.
the ones I've seen.
Well, you know, I'm still. I think my latest prediction was at the end of last year. I said I thought rates would be kind of in the mid 5s by end of Q1 into Q2. I guess I technically still have some time to get that one right, but it's not looking good.
Not likely. What are some misconceptions? Because this is like, let's say I wanted to get a loan. Maybe I'm not the right person, but let's say somebody wanted to get a loan.
Yeah.
What misconceptions might they not realize? You know, like.
So this is a great question.
Like self-employment.
Well, so there's a lot. The biggest misconception is that rate is the most important thing. Consumers care about interest rate, as they should. But there's too much focus in this world about interest rate. There are so many factors that go into the interest rate that when a consumer says, I'm just going to call around and whoever gives me the best rate wins, that's problematic. Because until you fill out an application, until you turn in all of your documents, you don't know necessarily what your rate's going to be. You know, Fannie Mae recently implemented a rate adjuster. We call them loan level price adjustments, but it's basically a rate adjuster. If your debt to income ratio is over 40%, your rate gets worse. Now, how am I going to tell you what your rate can be? I can give you an idea of what it's going to be, but if I don't have your credit score, because that matters, if I don't know the property address, because taxes and insurance matter, if I don't know all the income that I can use for you, how do I know that I'm quoting you a rate? Now, let's say that we're working together, right? And I've got all this information. I've given you a rate quote. you want to shop it around, you call around, well, you'll call ABC company and they might price it at a 780 credit score with a 40 or less DTI, but in fact, your credit score is a 720 and your debt to income ratio is 43%.
Right.
You're not getting an apples to apples comparison.
Right.
I'm not saying don't rate shop. You absolutely should, but there is more to it than just throwing out a number. In addition to that, what are you paying for that rate? You know, Quicken is really good about saying we have the best rate, and we have tons of customers that will show estimates from them. But then when you get it, the rate's lower, but you're paying 4 or 5 or 6 points to get that rate. In which case, well, okay, we can do better than that, but also you shouldn't pay that many points.
Right.
It doesn't you'll never convince me that paying 4 or 5 points makes sense.
Right.
1 or 2, sure, especially in today's environment.
Right.
It's not only just getting the absolute lowest deal. Are you working with a competent loan officer and a competent company that's going to be able to help you actually see this thing through to the end? Now, I like to tell customers getting a loan sucks. It just sucks less with us, which is true. I mean, you do have to give over a lot of documentation, and there's going to be a lot of back and forth. And now that your debt to income ratio matters for the rate, it's going to be even less fun.
Right.
Most people don't know what they pay their CPA. Most people don't know what they pay their financial their financial planner, their financial advisor. People get too focused on interest rate, and that's it. What is the best package for you, right? Do you need to do an FHA loan? You're a veteran. Does that mean that a VA loan is the best way to go? Maybe, maybe not. What about a conventional loan? Should you put less down? Should you put more down? There's so many factors that go into it. You need to work with a very well qualified, competent technician of a loan officer that can show you all of your options and really lay out a plan versus where am I getting the absolute lowest rate?
I think that part of what stemmed from this question was, and maybe it's my own fears, when you're in escrow, having somebody who's going to take you to the finish line.
That's right.
You could have everything, all your ducks in a row, your inspection's fine, there's no problems with with anything with the property, and now the financing.
Right.
And you need to have somebody on your team that is going to carry you to the finish line. And that's where, it would make anybody nervous.
Of course. And so, like you said, self-employed, right? Like I could go through a million different things. How many businesses do you have? How many business tax returns do you have? Are they flow through entities? Are they a C Corp? Are you 100% owner of the C Corp or not? That's going to make a difference. Are you using business funds to close or for reserves? Okay, well then we need to go through the business statements and make sure the company can support using those funds and that the business won't go out.
Right.
Are you taking distributions and reporting those to the IRS? If not, we have to do liquidity tests. There is a gajillion different things that go on, and good loan officer, I mean, that's like 15 and 30 seconds, right? I mean, you've got to be working with a true professional that understands exactly what they're looking at. I talked to a young lady today who is a physician, and she's not paid just a normal hourly wage. She's got differentials. She's got all sorts of different things. Right. And she's got some fixed pay and some variable pay. Right. And she said this other company that she's been talking to, they've been 2 weeks trying to figure it out. I told her what her base income is going to be in the first about 3 minutes of the phone call. Okay. You have to know, you have to be experienced. Yeah. You have to know what you're doing.
Right.
You have to know what you're doing. And for loan officers out there that haven't been doing it for a long time, I recommend that they team up with a loan officer that's been doing it a long time. Join that team. Right. Get a mentor. Get people to help you. The only way to learn is to do.
Yeah, and with other people together, you learn from other people's experience. I think that I've seen that work really well in so many different, like one of my friends is a broker in LA. Always worked with somebody who's older, experienced, and now he's one of the biggest brokers in LA. And it's like I could see his formula. And sometimes you'd see two people, they personality-wise, total, not mismatch.
No, yeah.
But as a team, they really complemented each other.
That's right. That's right.
Yeah.
And that's what we try to do here. Honestly, like our big thing is we have what we call study hall every week. And it's not mandatory, but all the loan officers get on. And I'll generally kind of give a state of what we're seeing this week and what's going on. And then it's like, let's talk. What troubles are you having? What wins did you have? And people be like, hey, I'm working on this and I can't figure this out, or hey, I messed up on this thing and this is what I learned from that situation.
Right.
I try to be, for my loan officers at this company, I am here for them to help bounce things off of and figure things out and work through problems and how do you structure this and put the pieces of the puzzle together.
Right. Okay. It's interesting. Other things people don't realize that they need to have, when they're going to look at a house and they're going to get an FHA, mold issues, structural issues. What other kind of issues are so like that you will not get a certain type of loan if you're not 100% on?
The thing is at the end of the day, when you look at it, VA specifically is really strict on you have to have a wood destroying insect report.
Okay.
There cannot be any conducive conditions on that report. If there are any conducive conditions, they have to be remedied. But again, it comes down to who is the inspector that looked at it. Technically, wood touching the house is a conducive condition. Is the inspector going to call that out?
Right.
Are they not? At the end of the day, though, like for loans across the board, the house has to be safe, sound, and habitable.
That's the FHA.
That's FHA rule? Conventional VA.
Right.
The house has to be safe, sound, and habitable.
Yeah.
If you can see daylight through the middle of the wall, that's going to be a problem. Okay. If you can see that water's coming in through the roof, that's going to be a problem.
Well, I'm wondering that question because sometimes for structural issues, it could be $20,000 that you have to come out of pocket just to close.
That's right. An appraiser might go in there and see a lot of settlement and cracks and the house is shifted a little bit. They might call for a structural engineer to come out there. And then the engineer is going to say, yeah, no, it's fine. Or no, it's not. Right. You have to do X, Y, Z. That's just a thing that happens. Right. But that's why having a really good real estate agent is so important. Just like having a really good loan officer that's a technician and can get you through all of it is important. Having a really qualified, good real estate agent is also just as important because they're going to be able to see a lot of that stuff going into it before you start spending money on earnest money and option money and appraisals and inspections and all of that. They're going to be able to look at it and be like, I don't know, like maybe you have this issue, maybe you don't, and really guide you through to make the appropriate decisions.
Well, it's like your team. It's the buyer's team. It's a team of experts that kind of tell them, and brokers aren't usually responsible for that, but somebody who's got the experience would be able to see that. And even inspectors, most of them, their contracts when you hire them says they waive anything that they mess up on they're not responsible for. So technically, they could just miss everything,
right?
And you have no recourse,
right?
So having a good broker, knowing what to look for. I ask everybody these wrap-up questions. It's what are your 3 key daily habits? Like, do you have habits or?
I have some. I get up. That's enough. No.
I hope so.
I wake up. First thing I do in the morning, every morning, I grab my phone. I start looking at the news.
Okay.
What's going on in the world? What's going on in the financial industry? I go to the gym. I think it's really, really important for me. I'm not the most athletic guy, but being in the gym for that 1 hour every day where I can only focus on the task at hand and I'm not thinking about all the outside noise in the world around me, really, that's my biggest stress relief. And then when you're in the mortgage business, you don't know what the days are going to bring. I may think I know what I'm going to do today and it gets completely thrown off course. Okay. But I would say reading the news, physically taking care of myself, and having time with my family every day.
Okay. Those are your 3 key daily habits.
Yeah.
I think that's great. I think it's so healthy. I'm smiling because I'm just not good at it, but having like a work-life balance.
I'm not great at it.
Yeah.
I've been getting better.
Yeah.
If there's any blessings in the slow times when things aren't great, it's that you have more time to kind of realize I need to focus more on my family and I need to be around more.
Right.
And as much as this last 7-8 months has not been fun work-wise, I've definitely realized how much more time I should have been spending with my family prior to it. And I've really tried to make that a priority.
That's super interesting. Well, you have kids and you think about the future and
Yeah.
you plan. I mean, do you have like a legacy that you want to leave from your business? Like what do you love to give to the world?
What do I love to give to the world?
You're hiring people, you're training them, and you're giving them, you know.
I want to help people be great. I'm not necessarily building this business to leave to my children. I don't know if my kids are going
Right.
to want to be in the mortgage business.
Right.
You know, right now, my daughter wants to be a princess that rides unicorns,
Yeah.
and my son wants to be a coder. You know, he's super into video games. I don't know what they want to do. What I want to leave what do I want my legacy to be? When I'm gone, I want people to think he helped people. He helped me. He helped me grow. From the business perspective, I would love to have a legacy in the mortgage business. You know, this guy was one of the top loan officers in the nation for a long time. And then he created a company that became one of the best companies, maybe not the number one company. And I'm not looking to be the biggest company by volume. I just want to be the best company. Did I create the best company out there where loan officers and operations people can come together at a place that they want to work? They believe in the culture. They believe in each other. They're all vying for the same goal. And did I make them better? Can people come here and learn and become a better processor, loan officer, underwriter than when they got here? And maybe people don't stay there for their whole career, but can they look back and say, man, the best place I ever worked and where I learned the most was at Loan People?
Yeah.
That's what I want.
Yeah. That's special. Well, Max, I look forward to having dinner with you tonight. 'Cause
Me
I'm
too.
hungry.
Me too.
And, awesome, man.
Thanks for
fun.
coming and doing this, man. I appreciate it.
It's my pleasure for sure.
Hey guys, thanks for watching my video. I really like making these. If this video added value to your real estate thinking, forward it to somebody who you think it could help. I have a newsletter that goes out about once a month. Come to my website, signetinvestments.com, SIGNET investments.com.